Let's talk about the impact on the markets on all of these things. Joining us this morning, Janice Henderson, Equities Portfolio Manager. Jeremiah Buckley is with us. Jeremiah, happy Friday. Good to see you.
Yeah, good morning, Carl. Thanks for having me.
I wonder if you think the impact of any kind of tariff action gets a little muted when you look at how much this White House appears to want to let the economy run hot.
Yeah, so certainly, as we've seen, we're seeing today, higher tariffs, higher tariff rates are negative for the market. Trade deals are positive for the market, and we need to see the offsets to those higher tariff rates as it does impact companies. But certainly, fortunately, we're starting from a strong base. The economy is strong. I think earnings, as we go into earnings season over the next couple of weeks, we're optimistic that we're going to see positive results. The results we saw from companies in June, and Delta kicked it off, and Levi kicked it off here the last couple of days, and those results were positive too. So fortunately, we're starting from a very strong point with the economy, but ideally for the market, we'd like to see more trade deals and less increases in tariff rates.
Right. How do you think the banks next week sort of set the tone for Q2?
So I think it's going to be positive. So we saw a lot of them raise their dividends last week, which I think is a good indication of how they feel about forward growth, as well as their ability to return capital. But I think there's a number of positive catalysts. I think we'll have net interest income margins continuing to increase, not only this year, but into next year. You've seen, again, some signs of deregulation that could open them up into growing assets further. And so we've also seen capital market activity improve as M&A has picked up, as we've seen a little bit more certainty around the environment. And so all of those bode well for the banks and their ability to grow earnings here going forward.
I wanted to ask you a little bit about travel and lodging and what we're seeing here. It's been amazing to hear from the cruise lines about their bookings through the second half of this year. What do you expect to see in terms of appetite for that consumer discretionary spend?
Yeah, so the consumer continues to be healthy. We've seen real wage growth continue to be positive, up 1.5%. That bodes well for discretionary spending. Discretionary spending has grown faster than spending on staples. And we think that experiences will continue to grow faster than goods. And we've seen evidence in that in Carnival's earnings release. Delta, in their comments yesterday, talking about a second half improvement. As well as the premium customer continue to be strong. And so we continue to believe that the demand for travel continues to be positive. And we've seen a little bit of softness here in the U.S., but if you look globally outside the U.S., there's even more strength. And so a lot of the companies like a Booking or a Marriott have very global exposure, and so they're benefiting from that growth outside the U.S. as well.
And in fact, what we've been hearing from Marriott and Hyatt and others is that even where the Canadian to the U.S. traveler has been suppressed, or Mexico into U.S. traveler has been suppressed, there's been such a boost internationally that all things come out even. That's not to say that for the 60% of hotels in this country that are small businesses, that there's not an impact, but certainly for those names. And Booking Holdings, I mean, I'm looking right here, year to date up 14%, so over 6 months, 20%, pretty good.
Yeah, they've executed really well. They've had strong growth in their nights booked, and they have a lot of exposure outside the U.S., particularly in Europe. And as we talked about, a lot of that growth has been better than what we've seen domestically here in the U.S.
Finally, Jeremiah, what do you make of this debate about the fact that the idea that software is no longer eating the world, it is hardware, and that software is somehow vulnerable because of how the employee relationship with the UI is going to change over time?
Yeah, it's a controversial topic that we continue to debate internally. I think what we're focused on is making sure that the software companies that we are investing in are leading on AI. They're incorporating AI into their products. They have AI-first offerings to their customers. And so that they won't be cannibalized by AI. But it's certainly something that we're watching. I think it was interesting. I read an article about Goldman Sachs hiring their first autonomous AI engineer. And if that's the case and we have continuation of that, certainly the AI infrastructure demand will continue to be much faster and go for a lot longer than we expect today. But it's really important for those software companies that are providing that infrastructure and those applications to adopt AI. Certainly, they're benefiting from it today. They're using AI to write more code and faster, but they need to continue to be relevant as we transform into this new environment.
Yeah, just even yesterday, comments from Microsoft about the percentage of code that's getting written by machines is pretty unbelievable. Jeremiah, have a great weekend. Appreciate the help.
All right, thanks a lot.